So, you're holding some Ethereum and you want to make it work for you? Put it to work earning even more Ethereum? Well, you are in exactly the right place. In this explainer, we are breaking down everything you need to know to earn passive income on your ETH, looking right ahead to 2026.
All right, let's just get straight to the point. The headline number you're probably looking for, right now, it's hovering around 3.1%. That's the average annual yield you can expect from staking your ETH today. Now keep in mind, this rate is dynamic, it's always changing, but it gives us a really solid baseline for what's possible.
And make no mistake, staking is not some niche activity anymore. I mean, we're seeing massive institutional confidence. Just look at this number. Over $125 billion have been flowing into products like Ethereum ETFs. You know, when the big players get involved like this, it's a huge signal that the market is maturing. And that means more people are staking their ETH than ever before.
Okay, so what is staking anyway? How does locking up your crypto actually help power the second largest blockchain network in the entire world? Let's dig in.
You know, the easiest way to think of it is like earning interest in a high-yield savings account. But, and this is the really cool part, instead of a bank just holding your money, your capital, your ETH, is actively helping to run and secure this giant global computer that is Ethereum. By staking, you're not just an investor, you're an active participant in the network's security.
All of this is possible because of Ethereum's landmark shift away from proof of work, that's the super energy-intensive mining process that Bitcoin uses, over to proof of stake. And the impact has been, well, nothing short of historic. We're talking about a more than 99% reduction in energy consumption. It made the network incredibly more efficient and, frankly, a whole lot better for the planet.
Okay, so you get the why. Now for the how. How do you actually do it? Well, there are basically three main paths you can take on your staking journey, and each one comes with its own distinct set of trade-offs. You're balancing control, convenience, and of course, rewards. So, path number one. This is for the purists, the tech-savvy folks out there who want maximum control and absolutely zero middlemen. This is you running your very own validator node.
The pros of solo staking are awesome, right? You get to keep 100% of the rewards your validator earns, and you're directly contributing to the health and decentralization of the entire network. But there's a catch. It requires a pretty hefty investment of 32 ETH to even get started, and you need the technical know-how to run a server 24/7 without ever going down.
And this quote just captures that spirit perfectly. It really is the gold standard. It's the most authentic, the most direct way to participate in securing the network. It gives you complete sovereignty over your assets and the role you play.
But let's be honest, not everyone has 32 ETH just sitting around or wants to be a full-time system administrator. So what's the alternative? Well, that brings us to path number two, which is easily the most popular option for most DeFi users. It's called liquid staking, and it gives you this powerful blend of rewards and flexibility, all while solving that problem of having your capital totally locked up.
So with liquid staking, you can stake any amount of ETH you want, no minimum. In return, you get what's called a liquid staking token, or an LST. Just think of it like a tradable receipt for your staked ETH. You can then take that token and use it in other DeFi apps to earn even more yield. The trade-off? You're trusting your funds to a smart contract, and you're paying a small fee on your rewards to the protocol.
Now, if even that sounds a little too complex, don't worry, there's a third path, and this one is designed for maximum simplicity. This is the one-click solution. It's perfect for beginners who just want to prioritize ease of use above everything else. We're talking about staking on a major centralized exchange, like a Coinbase or Binance. It could not be easier, but that convenience definitely comes at a cost. You're going to see lower returns because of higher fees, and most importantly, you're handing over control of your crypto to a company. You don't control your own keys, and that's what we call custodial risk.
So we've covered the three main paths. Now let's put them all side by side. Let's do a little head-to-head showdown and see how they stack up on the metrics that matter most. This table just lays out the fundamental trade-offs so perfectly. Look at the top row for solo staking. High capital requirement, but the highest potential yield and the best score for decentralization. Then, as you move down the table, you see this direct relationship, right? The more convenient it gets, the less control you have, the lower your potential yield gets, and your risk profile completely changes. Okay, it's time for a quick reality check. Because earning that yield is only half the story. You have to understand the very real risks that are involved, because no method, none of them, is entirely risk-free. Each path comes with its own unique flavor of risk. For a solo staker, it's technical penalties, something called slashing, where you can actually lose some of your staked ETH if your validator goes offline. For a liquid staker, the big risk is a bug or vulnerability in the smart contract's code. And if you're a centralized user, well, you're just trusting that the exchange is going to protect your funds from hacks or from going insolvent.
And here's something really important to remember. Beyond your personal returns, the choice you make has a ripple effect. It directly impacts the health, the security, and the very philosophical foundation of the entire Ethereum network, which is, of course, decentralization.
When we actually look at where all the staked ETH is sitting right now, a very clear picture emerges. You can see that liquid staking protocols and centralized exchanges, together they control the vast majority of the network's total staked value.
This concentration raises a huge, critical question for the entire ecosystem. I mean, we see a trend where one single liquid staking protocol secures nearly a third of the entire network. And while it's super convenient, you have to ask, does having so much economic power in just a few hands undermine the very decentralization that gives Ethereum its value in the first place? It's this ongoing debate, this balancing act between convenience and core principles.
Okay, with all of this information, the methods, the risks, the rewards, and the big network implications, how do you actually decide which path is right for you?
Well, ultimately, the right path really just boils down to your personal profile. As this guide shows, it all depends on your technical comfort level, how much ETH you have to stake, and whether you're prioritizing simplicity, flexibility, or total control. Your answers to those questions will point you to the right choice for you.
So we've laid out the paths, we've walked through the trade-offs, and we've talked about the bigger picture. We've shown you the data and the core debate around decentralization. And so now we turn the final, and maybe the most important, question over to you.
Which path do you think is the best one, and why? Are you a solo staker at heart, a big fan of liquid staking, or do you just prefer the simple life on an exchange? Let us know your strategy down in the comments below. We'd love to hear what you think and answer any questions you have. And of course, don't forget to subscribe for more explainers just like this one. Thanks for joining us.